myself Sasi. I am the one who taking FA Financial Accounting at the Institute of Sai. Today I am going to give a glimpse of IAS to inventories here. First, what are inventories? Inventories are assets, for example, raw materials, work in progress, and finished goods. Then you may think, what is the purpose of IAS to inventories here? It is a standard set by International Accounting Standard Board that provides guidelines for valuation and accounting treatment for inventories. Valuing inventories. As, as I mentioned earlier, IAS to inventories provides guidelines for valuation. For some businesses, for example, manufacturing entities, inventories can be a significant figure. Inventory forms a major part of the assets of some companies. As I mentioned earlier, be it raw material, be it finished goods, be it work in progress. A major part of the assets of the it is the major part of the assets of the companies. So the value placed on the inventory can make a big difference to the profit or loss reported. How do the companies valuing their inventories? Inventory must be valued at the lower of cost or NRV. Let's start with cost. For example, cost incurred for bringing the raw materials to the company. Cost. Cost is the cost incurred in the normal course of business in bringing the product to its present location and condition, including production overhead and cost of conversion. It includes all costs to make inventories of finished goods ready to be sold. Cost may include purchase cost, cost of conversion, and other costs. We will be discussing the cost involved in making a purchase price, purchase cost of the product, import duties and other taxes. These are the costs when we import raw material from other countries. Transport, handling and other attributable cost. The cost will be incurred for transporting the goods from supplier's premises to ours. Net of trade discounts. It is a price that you pay for the item, excluding any discounts. Next, conversion cost. It refers converting raw material into finished goods. It includes direct labor. Labor activity refers to the process of converting raw material into finished goods. Variable overheads such as heat and light expenses and all allocation of overheads like depreciation of the factory plant. Other cost. Any other cost incurred in making the inventory saleable, like storage cost. We will incur storage cost when we keep finished goods for selling. As I mentioned earlier, inventory should be valued at the lower of cost or NRV. Here we will discuss net realizable value NRV. Goods written off or written down. It refers to reducing the value of inventories. Net realizable value. Net realizable value is the estimated selling price less the cost to completion and any selling and distribution cost. For example, chemicals. If we kept them for a longer period, they would deteriorate. So we would incur some repair cost. Then we have to sell it. The formula for NRV, net realizable value, is expected final selling price less cost to get items ready for sold, less selling cost. Then you will get net realizable value NRV. These are the reasons to write off goods. Goods write off are goods written down. It refers to reducing the value of inventories. Goods lost or stolen. Perhaps the goods could be expired or leading to a theft. Goods damaged or deteriorated. Goods become obsolete, no longer in use or no useful life. Production errors. Maybe the design of the product could be changed. Fall in selling price in the market. It could be competitor has introduced the same product. In the live classes, we will cover the computation part of these methods. If you are looking for a classes related to ACCA, you can get in touch with Bhavani ma'am. Thank you.